Hello and welcome to you all. My name's Emma Cook and I'm delighted today to be hosting Magellan's In Review Analyst Roundtable discussion. Market uncertainty is perennial, yet the current combination of persistent rising inflation, central banks being forced to raise rates to temper this inflation, and both stocks and bonds entering bear market territory feels new. We appreciate the challenge that you face in making decisions for your investments, in trying to see them through this period of volatility, and ultimately in trying to ensure that you have positive outcomes for your investment portfolios through time. So today I'm pleased to be joined by a few senior members of Magellan's investment team to discuss how we're navigating the macro environment. I have Adrian Lu from our Technology, Communications and Media team, Hannah Dickinson from the Consumer Franchises team, Alan Pullen from Financials, and Ben McVicar from our Infrastructure team. Thanks for joining me today, guys. So let's kick things off with inflation. Obviously, it's something that everyone's not only hearing a lot about, but feeling on a personal level on a daily basis. Whether we're at or near the peak of these inflationary pressures is unknown, but I'm interested to get your thoughts on how consumers are likely to fare in an inflationary environment that persists and how businesses are coping with these rising costs and challenged margins. So perhaps a starting comment from each of you. Hannah, do you want to kick things off?
Sure. So inflation is nothing new. Brands and retailers are dealing with a little bit of inflation in their cost base each year, and usually it's a pretty simple pass-through exercise, so they can take a little bit of pricing and pass that through to consumers. I guess at the moment, the problem is that that nice relationship might break down for some companies because firstly, you have inflation being much higher than it has been in the past, but also the duration of it is much longer than many companies expected initially. So that's when it can start to pressure the margins of companies, when you see consumers start to respond negatively to those price increases by either pulling back on consumption or trading down to cheaper products. So you really want to be well positioned at a time like this. Asset selection is very important. You want to be positioned in companies that are either structurally advantaged in an inflationary environment or companies with enough levers to mitigate the impact of the inflation in their cost base. So when I think about our portfolio, we've got McDonald's and Yum, the restaurants that are naturally well positioned because of their franchised business model. We've also added a position in Diageo, which is a spirits manufacturer. So they have high gross margins, which makes them structurally resilient to inflation. But they also produce a lot of aged product, like 12-year-old Scotch, which means some of the input costs that they're absorbing at the moment were actually accrued many, many years ago. So that's positive. Then in terms of our consumer staples exposures, they do have a bit of cost inflation coming through, but they have enough tools in their toolkit to offset that. So you might have heard of this concept called shrinkflation, which is where companies start reducing the size of the snack bar or putting less chips in the chip packet. And that means they're getting better price realization on a unit basis without consumers noticing. The other thing they have is just really strong pricing power because they have differentiated brands with really strong consumer loyalty.
Adrian, how does the tech sector fare?
Well, pricing power is actually something that we like very much in tech as well. We tend to focus on companies with very strong competitive advantages. So if you think about companies in software, for example, these are companies that have strong pricing power. Hardware is a little bit more of a mixed bag because you do see a lot more undifferentiated commodity-like players within that space. But within the areas where we like to focus, and semiconductors in particular, you do see a handful of deeply advantaged companies with strong pricing power, in many instances because there's simply little, if any, alternative to what they have to offer. And maybe just sort of rounding it out, if I look at digital advertising as another example, how the digital ad platforms like Meta and Google monetize, for instance, is selling their advertising inventory through through auction-based, I should say, bidding systems. So they're effectively clipping the ticket on where the prices get bid. And so we think a business like that should fare relatively well in an inflationary environment.
Al, in financials?
Well, financials don't tend to have many inputs that go up in costs like oil or other cost of goods sold. So they're a little bit different to other sectors. And for example, in Visa and MasterCard, the payment companies where we have pretty big positions, inflation can actually be an advantage to those companies. They make their money by just taking a small percentage off all the flows of payments that go across their system. And as prices go up on goods and services, the value of those flows actually goes up automatically. And that flows through into the revenues. They don't have to change pricing. It kind of automatically goes through. And as I was saying, they don't really face higher costs in terms of transport costs or other cost of goods sold. So they can actually be a kind of good place to be during an inflationary environment.
Bit of a toll road on the superhighway of payments.
Absolutely.
How do the real toll roads go, Ben?
Yeah, so when you think about infrastructure, it tends to be pretty well inflation protected. Not something that has been talked about so much in recent years. Obviously, inflation has been much more subdued, and now it's coming to the fore again. When you think about infrastructure, you can really think about it, for example, toll roads. Very good inflation protection. Why? Typically what you have is toll prices will be directly linked to inflation. So if CPI goes up on a quarterly, annual basis, whatever that particular contract is, you'll find that you can increase your prices and therefore protect your real earnings of that business. Utilities, it tends to work a little bit differently. What you'll tend to find is that in some jurisdictions, you do get that direct indexation pass-through. In other jurisdictions, and in almost all jurisdictions, in fact, what you'll tend to find is that you can go back to a regulator and say, my costs are increasing, I need to increase my prices to make sure that you can actually pass those through and still earn a fair return on your business. So overall, infrastructure tends to have very good inflation protection.
Now, one of the culprits driving inflation has been this restriction in supply for goods and even energy, thanks to the pandemic and obviously the geopolitical tensions that we're well aware of now. We've all no doubt felt the delicacy of supply chains, no least in the supply of toilet paper. Ben, how have the infrastructure assets coped with this tension?
Yeah, we've certainly seen the evidence of it when we look around the market. So, for example, a lot of infrastructure assets are transport assets. And so you do see the signs of that congestion. So you sort of think about things like the ports in LA. I think most people have heard the stories about boats being piled up trying to get berth in so they can offload their goods. When we think about the investable companies that we look at in infrastructure, really where you find the issue is most in the freight rail business in North America, the assets we look at there. What you tend to find is that those companies, there has been an impact in terms of how well the networks run. There's been some congestion. But what is really interesting is these businesses are not just a direct play, for example, on volumes. These businesses have still actually delivered growing profits. And how have they done it? Well, ultimately, they've managed to increase prices and they continue to reduce costs in their businesses. And that's really the investment case there, not about volume growth. So they've done all right in that case. I'd be really interested at this point. I suspect Hannah has some interesting comments on the consumer side.
Consumer companies that we're looking at, they're in a very difficult operating environment because of some of the challenges you're talking about. So there's supply side and demand side imbalances for these companies. So on the supply side, there's manufacturing headwinds because China's in and out of lockdown with its zero COVID policy. There's the freight bottlenecks that you were talking about. There's worker shortages, particularly in the US, that are a real challenge. And then on the demand side, COVID's just created this huge distortion, really. That means that the underlying patterns of demand have become quite difficult to understand. So we've actually seen some, I suppose, embarrassing forecasting errors for certain management teams in the past few earnings seasons. And these are, typically well-run, well-managed companies. So there are certain companies we've actively avoided because of their exposures to some of the headwinds I've been talking about. So companies like the mass retailers in the US, which are high quality companies, they're companies we would own at the right time, at the right price, but they do have really large labour forces, they have exposure to freight inflation headwinds, and they have a very difficult time at the moment managing their inventory because of those demand challenges that I was talking about, the difficulty in predicting demand. So they've had to come and downgrade their guidance for the full year, some of those players. On the other hand, we have lent into some of the names that perhaps have been exposed to some of these headwinds, but we think the earnings or the price reaction has been too extreme in the circumstances. So a company like L'Oreal, which is facing some issues in China because of the lockdowns there, but L'Oreal's incredibly well positioned to withstand those headwinds and navigate them. They've got multiple distribution centres across China, which means that they can continue to serve their consumers via e-commerce even while plenty of stores are closed and consumers are in lockdown. So.
Well, it's actually really fascinating how intertwined some of these supply chain disruptions have been across the sectors when I hear about the things that Ben and Hannah have talked about. So Amazon actually called out its own supply chain disruptions, but they've been able to manage it better because they've got their own logistics facilities in place. So when I look at the hardware sector, which is the most exposed within the tech space for obvious reasons because they're shipping physical product, and semiconductors in particular, where they've actually been one of the culprits of the supply chain issues. And the reason for that is that we've had a period of undersupply in chips. And when you think about all the products that actually rely on chips, and think of things like computer chips or sensors in your vehicle, when you don't have these key inputs, you actually hold up a lot of products being manufactured downstream. Now, you actually see the effects of supply chain disruptions even across the parts of the industry that don't ship physical product. So when you look at digital advertising, for example, we had Meta or Facebook and Snap calling out digital advertising being disrupted by supply chain shortages. And software as well is actually a really interesting beneficiary, and you wouldn't think it. How could they be tied to these supply chain issues when they're not shipping actual physical product? But what the last couple of years exposed were some of the flaws or shortcomings in existing supply chain management systems, and that's really increased the urgency of manufacturing and goods companies to modernise their digital infrastructure, and we've seen software really benefit from that.
Now, the obvious consequence of persistent inflation is that central banks are obliged to put the proverbial brake on and raise interest rates in order to get inflation back into their target levels. We've been in a predominantly falling interest rate environment now for 30 odd years. So perhaps Al, I can start with you. What are the first order and second order consequences that you're thinking about with respect to financials as the inevitable happens as interest rates rise?
Yeah, it's a really important question, Emma. Interest rates are super important for most companies, and of course we've seen it have an impact on valuations for markets overall over recent times. In the financial space, it's interesting, particularly with banks, for example. Interest rates are absolutely vital there, but banks are one of the few kind of sectors where it's actually potentially a tailwind for those companies, and that's because they earn their money on the difference between what they pay to depositors and what they earn on their loans. As we've all seen with the recent rises in interest rates, even here in Australia, the deposits don't tend to go up as much as the rates on the loans when rates are going up. And so those banks can actually make more money in that environment. But you're right about the second order impacts. It's important to remember that. And what we could get out of this is potentially slowing growth. And that, of course, could weigh on asset quality for the banks if we get a slowdown in the economies. So it is important to take into account those second order impacts. There are pluses and minuses. On balance, we think a small position in banks is probably a sensible hedge against higher rates. However, you've got to be really careful to make sure you're getting the highest quality banks, look through their loan books to make sure there's nothing there, and with a good history in asset quality. So pluses and minuses for the banks.
Now, Ben, infrastructure assets obviously tend to carry a lot of debt, and they're also sometimes, often seen as bond proxies. So how do you see the infrastructure assets reacting to these increasing rates?
Yeah, it's a really interesting question that we've been thinking about and talking about at the moment, which is this issue of rising rates and the long duration nature of infrastructure assets more generally. When we think about it, that's the headline view out there. When we think about the actual exposure to infrastructure assets, we kind of break it up a few different ways. We think about one, what is the earnings impact? And believe it or not, there's actually a positive correlation we find between rise in interest rates and infrastructure earnings in general. it gets a little bit detailed, but when you think about the rise in recent interest rates, what's driven that, it's really been about inflation moving up, inflation expectations. We touched on earlier how inflation tends to be a pass-through. So if you get inflation going up, you'll find a toll road's earnings tend to go up with that. When you look at utilities and those types of businesses, what you tend to find, without getting too deep into it, what you tend to find is that their allowed return on their capital they can earn goes up, and that leads to higher prices ultimately. So again, there's a positive correlation there. So generally there's some buffer there on the earnings side. When you then think about the balance sheets, which I think is a question a lot of people are thinking about, what is really pleasing is whilst rates are now rising, and it's been a very recent phenomenon to see rates going up all of a sudden after, as you say, a very long period of decline, what is really pleasing is that a lot of these management teams of these infrastructure businesses have just spent the last however many years, 10 odd years, really locking in some of those low rates and terming out balance sheets. And so what we've seen is a number of companies, for example, we have a couple of companies operating out of Italy who have all-in cost of debt floating around a percentage point, on a multi-billion euro balance sheet. And we also did a really good example, maybe just to bring this to life, is when you think about a company like Zurich Airport, they issued debt at the back end of 2020 at 0.1%, 200 million Swiss francs, at a 7-year tenor. So really cheap debt, really long life. And so this is one of the things we think about is, yes, if rates go up, the cost of funds will ultimately increase for these businesses. I think it's just going to take a lot longer than people realise ultimately for that to play out.
So it's a long-term problem for them that they can manage
And it
between
depends.
now and that rolling over.
Absolutely, and it depends on where rates ultimately go in the future as well.
Thanks. Now, all of these conditions obviously lend themselves to the risk of recession or maybe even stagflation. Al, what do you think the risk of stagflation actually is? And then how do you think about business resilience in a recessionary environment?
Yeah, no, obviously the economy is under pressure at the moment. Central banks are way behind the curve in terms of raising rates to fight this inflation. There is a chance that they make a mistake. They're looking to tap the brakes a little bit just to take enough pressure off to ease the pressure on inflation. But there is a risk that they actually push the economy into a recession. In that environment, you really want to be owning quality companies with strong balance sheets and sound business models. That is kind of what we do at Magellan. We do think those are the types of companies that will outperform over the cycle, but when you particularly want to be invested in them is during times of economic weakness. That's when they're going to be really shining bright. In terms of the question on stagflation, I don't think we're likely to get an extended period of stagflation. Central banks do look like they're getting serious about fighting inflation, and they are much more independent than they were in the 70s. So I think after a period of higher rates and lower growth, we will get back to a more normalised environment over time, but it could take a couple of years.
Hannah, in the consumer space, are you seeing signs of the consumer moving into a tougher economic environment?
Perhaps surprisingly, given everything we've talked about, demand is still incredibly strong for the most part. People have healthy balance sheets, the employment is strong, they're spending, they're out there travelling, they're buying jeans and dresses and things for weddings, they're spending on luxury items. Demand is quite healthy. There are, we're always monitoring for, I suppose, leading indicators or canaries in the coal mine. And we haven't seen too many at this stage across the companies we're looking at. But one I would say is that we've heard from some companies that lower income consumers are starting to feel the pinch of higher gas and food prices. So that's something to watch. The other is in the financial markets more so. So we've seen a lot of early stage companies, not just tech companies, but early stage consumer brands that are growing really fast, but they're unprofitable. Their valuations have come off materially since the start of the year. So there's been a pullback in venture capital investment and equity investment into those companies. And what that means is that they will really have to start focusing on cash flow preservation. So they'll have to think about margins for once, maybe pull back on CapEx, pull back on hiring, even pull back on marketing. And these small brands, they've been competing with a number of the larger brands in our portfolio, like a L'Oreal or a Diageo. So the interesting, I guess, flip side to that is The bigger brands that are well capitalized, already profitable, they'll be able to continue spending, continue hiring, continue marketing. They might gain share of voice as these smaller brands pull back, and they might see this as an opportunity to gain share. So it can be a positive for them.
Now, finally, I'm interested to know from each of you, perhaps with a backdrop portraying for the majority, or for the most part, a lot of negativity, what is something that's really honing your focus now as opposed to from the conditions we've experienced over the last decade, and what do you remain ultimately very positive about? Adrian, I'll start with you.
Well, we're actually going through a really interesting time in tech in that we've seen the proliferation of business models that weren't really prevalent or weren't really even in existence in the last recession. So if I use software as an example, the adoption of cloud-based subscription models, many of which were really just established within the last 5 to 10 years. Cloud service providers like Microsoft and Amazon Web Services and Google Cloud were really in their relative infancies back during the GFC, and now are a considerable part of IT enterprise budgets. Now, if I look across the sector, we are focused on other areas, particularly as we look at the near term. For instance, what does post-COVID demand normalization look like in e-commerce? Or what does the risk of excess manufacturing capacity in semiconductors look like as we see a potential pullback in enterprise or consumer demand? Now, having said all of that, I should say that we actually remain really positive about the longer term prospects for the highest quality names within our space. As we look through this cycle, I can say that we firmly believe that e-commerce penetration should continue to rise through the cycle. Digital advertising spend should continue to increase in its penetration, as should cloud spending by the enterprise, as we're still in the relatively early runways of growth. And then when I look at on the hardware side, I think semiconductor or chip adoption should also continue to rise. So if I look through this, I'm very sanguine about the prospects.
Hannah, you painted a fairly positive picture about the consumer companies. Perhaps it's because you own the right ones. So what worries you?
So as you said, I'm not too worried. The consumer portfolio that we have is quite naturally defensive. It's quite weighted towards consumer staples. So that leaves me feeling pretty good. But I guess I'm cognizant of the fact that since past downturns that we might have looked at, like the GFC, consumer businesses have changed quite materially in that time. So you have to be conscious of what's changed and how it could affect them, if we do see another downturn. So for example, L'Oreal used to be very heavily weighted towards physical retail. It's now much more heavily weighted towards e-commerce. Its marketing has shifted from TV advertising to digital advertising. So I guess we just have to be conscious of some of the things that have changed. And for L'Oreal, I think it'll potentially make it more resilient, but you do have to be aware of it.
Al?
Well, I already talked about the short-term cyclical risks, and that really is kind of the downside I'm thinking about at the moment. So I'm going to switch straight to the positive, because I actually think with valuations coming back, we're starting to see some really good long-term investment opportunities for those investors who are able to look through the short-term and invest over that longer-term time frame. We've got high-quality companies with defensive business models, and they look set to deliver strong double-digit returns. So notwithstanding some concern on the near term, I'm starting to get positive on that longer-term outlook.
And finally, Ben, on infrastructure.
Yeah, sure. So as I just listen to some of these comments and reflect on really the overall picture here, and I think about how infrastructure fits in, infrastructure is really about essential services. So if you do find there's a macroeconomic deterioration, we're not so worried about it in the infrastructure space. If anything, we think infrastructure in a relative sense will do quite well in that environment because, for example, people are still going to be using, very clearly running water, electricity, toll roads, all of those assets still get used over time. So that's less of a concern for us. And I think on the positive that we're thinking about at the moment is there's actually a lot of really attractive structural growth stories that sit behind a lot of these infrastructure businesses at the moment. A couple of examples might include, this energy transition that we're seeing as we're seeing a lot of investment in electric assets really driving these irrespective of, the economic cycle. Or for example, in the communication tower space, you're seeing that booming demand for data through mobile phone usage really driving those businesses. There's a lot of sort of almost non-correlated or less correlated drivers for these businesses that we're looking at.
some really interesting ideas we could delve into more at some stage. Thanks, Ben, and thanks to you all for joining me today. We've heard from each of the senior investment team members about how they're thinking about and navigating the current macroeconomic challenges, and hopefully some of the specific examples bring to life the discipline with which we at Magellan seek to ultimately protect capital and deliver satisfactory investment returns. We really want to get investors safely to the destination, notwithstanding the bumps that we may encounter along the way. Thank you for joining us.